OPEC and its allies are set to extend production cuts after a breakthrough in negotiations. A delegate told Bloomberg that Russia and Saudi Arabia have clinched a tentative deal with holdout member Iraq. Now, the pair were pushing the producer to stop shrinking in its responsibility and cheating on output cuts. Now, the preliminary agreement still needs to be ratified. Well, still with us is Isabelle Mateos y Lago from BlackRock. Isabelle, what does oil actually tell us? Partly its demand. Is this a good indicator to see how global growth will perform?
So the oil story was had two stories in one. One was the collapse in demand, obviously caused by the global shutdown in activity. The other one was this feud among OPEC producers, which led to a spike in supply at the moment that you least needed it. I think that second part of the story is on the mend, and so is the demand side. So we're actually reasonably optimistic in terms of the outlook for oil in the second half of the year, and that will be frankly helpful for emerging markets, who in the main are well, certainly on the fixed income side are oil exporters. It will also help rekindle a little bit the very dire inflation expectations that prevail in most parts of the global economy. So at this point, it's a positive, and it's partly telling us the demand picture is improving, but of course it's also primarily around OPEC and the suppliers getting their act in order.
Isabelle, you're saying that this would be helpful for emerging markets. Is it more helpful to have a stable oil price than it is to have a range that actually is good for them?
So first of all, let me caveat that there are some very large ones, including China and India, for example, who are oil importers and don't benefit from higher oil prices. But for those who are exporters, I don't think stability per se is helpful if it's at a very low level that doesn't, allow them to, make money or finance the fiscal spending that they're accustomed to. So stability around 40 is one thing. I do think we're going to see quite a bit of upside because demand is likely to recover far more quickly than supply in the second half of the year, possibly even beyond that. As long as the range is not too wide, this isn't a worry for oil producers. The bigger concern is meeting their break-even point and meeting their fiscal spending needs. And that's easier to do,
Isabelle,
at around 40 or above than below.
Isabelle, I also know that you basically have increased the likelihood of some of your main risks. Now, you highlight them as 4 risks, which is U.S.-China competition, European fragmentation, Southeast tensions, South Asia tensions, and LATAM policy. Again, if you look at the price of oil and some of these commodities, how deep will they hurt emerging markets that will also be hurt by these 4 main risks?
So, that really points to another theme that we've been emphasizing, is that within emerging markets, there's a lot of heterogeneity. And, long story short is Asia is looking more solid. Why? Because it's emerging from the COVID crisis sooner. It's able to reopen its economy, whereas and it's mostly on the oil importing side of the ledger, and so has benefited from the weaker oil prices. LATAM, as you noted earlier in the program, is now the epicenter of the pandemic. There's a lot of political discontent, and there's a lot of commodity exporters who were hit by this double whammy of the COVID shock and the oil price shock. So really, you have to follow this on a case by case. But I would say, generally speaking, the U.S.-China tensions is one that is going to force every country in the world to essentially choose who they most want to be partnered with, and that's going to be a particularly tricky balancing act for countries in Asia, as in fact the Prime Minister of Singapore recently pointed out, because these countries have built their prosperity on having strong relationship with both the U.S. and China. And so that's a particular conundrum for that part of the world.